Hello friends and clients, I'm Paul Hutton, President and Wealth Manager at Hutton Wealth Management, and it's my pleasure to present our year-end tax planning workshop. Today's agenda is pretty straightforward. We'll review the year-end tax planning, and while doing so, we're also going to discuss some tax planning ideas and some strategies for you to consider. We'll also discuss some key tax proposals that are currently being discussed. We believe in educating our clients in their choices. Our goal today is to give an overview of the tax planning so that when you look at your situation, you have some strong foundational information. Please remember, each taxpayer situation should be looked at individually. The good news is that we're here and available to talk with you about your specific situation if you have questions. Before we begin the presentation, it's always important to review that there are 5 key areas of financial planning. Those areas are preservation planning, retirement planning, tax planning, estate planning, and investment planning. As a comprehensive wealth management firm, we try to always consider the impact of any of these recommendations that we make, not just in one of these areas, but in all of these areas for our clients. Today's presentation will be primarily focused on the tax and the estate planning portion. Tax planning for 2021 became a little bit more complicated because of the passing of some new rules and laws from the Secure Act, which was signed into law back in December of 2019. And the 2020 CARES Act also added some new laws and rules for taxpayers. With the recent proposal of new tax laws from the Build Back Better and other potential tax law proposals, it is helpful to review some of the tax changes that are being discussed so that you can plan in an informed way. Let's start by quickly discussing the differences between tax planning and tax preparation. You see, tax planning is looking ahead before the end of the year, whereas tax preparation is filling out your tax forms after year end. This workshop is about tax planning, not the preparation. It's about hearing some proactive ideas that you can consider now to potentially reduce your taxes. One of our founding fathers, Benjamin Franklin, is credited with saying, "By failing to prepare, you are preparing to fail." So, for 2021, there are still 7 tax rates. They are 10%, 12%, 22%, 24%, 32%, 35%, and 37%. Under current laws, this 7-rate structure, which was created by the Tax Cut and Jobs Act, is scheduled to automatically phase out on January 1st of 2026. For 2021, the standard deduction amounts for those who do not itemize are $12,550 for individuals, $25,100 for married couples filing jointly and surviving spouses, $12,550 for married couples filing separately, and $18,800 for head of households. So how should you view your itemized deductions if you do not take the standard deduction? Well, the old rule was to accelerate or realize deductions and then take them as soon as possible. With the higher standard deductions now, the new rule is to time or to plan your deductions. 2 of the more widespread deductions that taxpayers look at as they choose to itemize and not use the standard deductions are the mortgage interest and the state and local taxes. This is known as the SALT tax. You've probably heard about this on TV most recently. Under the new rules for mortgages taken out after October 13th of 1987 and before December 16th, 2017, mortgage interest is fully deductible up to the first $1 million of the mortgage debt. That threshold has now been lowered to the first $750,000 or $375,000 married filing separately on homes purchased after December 15th of 2017. For those of you with a mortgage, please check with your tax preparer for how much of a deduction you could take. The TCJA, or the Tax Cuts and Job Act, also limited state and local incomes, sales, and real and personal property taxes, the SALT, to a maximum deduction of $10,000. There have been discussions about changing this, but currently the $10,000 limit is still in place. Qualified charitable distributions, or what we refer to as QCDs, are still a strategy for retirement savers. As part of the Secures Act, required minimum distributions, or RMDs, were changed to start at age 72 instead of 70 and a half. Qualified charitable distributions are a tax law provision that allows retirement savers over the age of 70 and a half to directly distribute up to $100,000 to eligible charities straight from their retirement accounts and not pay taxes on the distribution. One idea that experts suggest is, if you are charitably inclined, to consider using part or all of your RMD for a qualified charitable distribution. Like many of the other strategies we're discussing today, this is one that you should see us about if you're interested in evaluating your situation. In 2021, long-term capital gains still receive a tax break. Currently, there are 3 tax rates: 0%, 15%, and 20% for long-term capital gains. One planning item that many taxpayers think about is tax gain loss harvesting. Harvesting capital losses is a strategy where taxpayers sell assets at a loss to offset capital gains. This reduces or eliminates a tax on current capital gains. On the surface, loss harvesting produces an economic benefit equal to the tax saved. However, sometimes it could only provide a timing benefit. This is a tax deferral strategy that could be very valuable if used properly. Capital losses are highly tax effective if they can be used to offset income tax at higher rates. A key fact to remember is if you can use up to $3,000 in capital losses above capital gains to offset ordinary income. Also, as a warning, watch out for the wash rule. This rule prevents a taxpayer from repurchasing a substantially similar security within 30 days of selling it at a loss. As an example, if you bought Coke and sold it and turned around and bought Pepsi, that would be a similar security. So be careful of those types of things. If you have any questions on loss or gain harvesting, give us a call. We'd be happy to visit with you, or you can talk to your tax professional. Capital gains harvesting means taking a capital gain in the current tax year. On the surface, it might appear that taxpayers should always harvest gains because of favorable rates. However, harvesting gain introduces a trade-off between lower tax rates versus the loss of tax deferral. Remember, when taking a gain for tax purposes, although the tax is paid at a lower rate, it is paid sooner. Remember to review your year-end retirement contribution planning. Here are some contribution plan maximums that could be applicable if you're participating in one of these plans. Another critical area to review before the end of the year is the Secures Act, which we're referring to as the Family Tax Bracket Management. Logically speaking, if you're in a higher tax bracket than your beneficiaries, then it might make sense to let them take the distribution after your death in their tax bracket rather than yours. However, if your beneficiaries are in a higher tax bracket, then it might make sense to take the distribution in your tax bracket before death and then convert these accounts to Roth IRAs, and then leave your beneficiaries an account that still must be taken out over 10 years but can grow tax-free. An annual step-up is considered to review your marginal tax rate and your beneficiaries' marginal tax rates each year. Some of the benefits from a Roth IRA conversion include they can lower your overall taxable income over the long term. Roth IRAs enjoy tax-free compounding. Roth IRAs have no required minimum distribution at 72. Roth IRAs allow tax-free withdrawals for beneficiaries. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. Primary include income taxes, income limitations for future contributions to Roth IRAs. In addition, if you're required to take out a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. Now let's talk about qualified tuition plans, also named 529s. These are a great way to tax efficiently plan the financial burden of paying for tuition for a child or a grandchild. Originally, earnings in a 529 plan could be withdrawn tax-free only when used for qualified higher education at colleges, university, vocational schools, or post-secondary schools. However, the rules changed, so now 529s can also be used to pay for tuition at elementary, secondary, public, private, or religious schools up to $10,000 a year. Pretty nice, isn't it? Unlike IRAs, there are no annual contribution limits for 529s. Instead, there are maximum aggregated limits, which vary by plan. Under federal law, 529 plan balances cannot exceed the expected cost of the beneficiary's qualified higher education expenses. 529 plans, well, they do vary state by state, ranging from about $235,000 to $529,000. Some states even offer state tax credit or deductions up to certain amounts. Contributions to 529s are considered to be completed gifts for federal tax purposes. So in 2021, up to $15,000 per donor per beneficiary qualifies for the annual gift tax exclusion. Excess contributions above the $15,000 must be reported on the IRS Form 709 and will count against the taxpayer's lifetime estate and gift tax exemption. Currently, those are sitting at about 11.7 million in 2021. There's also an option to make a larger tax-free 529 plan contribution if the contribution is treated as if it were spread out evenly over a 5-year period. For example, let's take $75,000 lump sum can be put into a 529 and applied as though it were $15,000 per year. Applied to the same beneficiary, it just has to be put in over that period of time. Grandparents sometimes use this 5-year gift taxing averaging as an estate planning strategy. If you want to explore using or setting up a 529 plan, it can be confusing, so give us a call and we'd be happy to go over the ins and outs of how those work and help assist you with that. Now, let's talk about annual gifting. We just talked about 529s. This is a great lead into what we're talking about now. You may give up to $15,000 tax-free to each giftee in 2021. These annual exclusion gifts do not reduce your lifetime gift tax exemption. This annual exclusion gift is doubled to $30,000 per giftee for gifts made by married couples. You can also help someone with medical or educational expenses without incurring gift taxes. There are opportunities to give an unlimited tax-free gifts when you pay the provider for these services directly. The medical expenses must meet the definition of a deductible expense. Qualified education expenses are tuition, books, fees, related expenses, but not room and board. You can find a detailed qualification in the IRS publication 950 and the instructions from the IRS Form 709 at irs.gov. A wealth transfer planning item to think about is the exemption amount for gift and estate generation skipping for 2020-21. And it's 11.7 million, as I just said earlier. Any amount over that is subject to a 40% federal income tax. This higher amount provides high net worth individuals a significant planning window to make gifts and to set up irrevocable trust. As a reminder, as of now, in 2026, the estate tax exclusion will return to approximately $5.6 million, which is $5 million adjusted for inflation. On November 26 of 2019, the Treasury Department and the Internal Revenue Service issued a final regulation under IR 2019-189 confirming that individuals who take advantage of the increased gift tax exclusion or portability amounts in effect from 2018 to 2025 will not be adversely impacted by the TCJA sunset on January 1st of 2026. If you have a large estate, please give us a call. We'd love to go over this in more detail to you because it will affect you when it comes to your taxes. Now let's review the most recent tax law proposals from the November 3rd Build Back Better Act framework released by the White House. Another proposal is to expand the 3.8% net investment income tax to apply to all net income derived in the ordinary course of trade or business for taxpayers with a taxable income greater than $500,000 for joint filers or $400,000 for single filers. Although it is not yet certain which tax law changes, if any, will be passed into law, we will try to update you as laws are passed. In summary, here are some items that you should review prior to year end for tax time. Get a notebook and write these things down. Let's go over them at our next meeting. What's your anticipated tax bracket? Are you going to take the standard or the itemized deduction for timing purposes? Have you looked at capital gains tax harvesting? Have you looked at retirement planning contributions? Have you looked at educational planning opportunities for your kids and grandkids? Have you looked at charitable gifting, planning, and estate planning opportunities? It's also helpful to think about tax planning for any major financial or life events next year or in the future as well, as tax planning for many other personal situations concerns. One of our goals is to continue to help others. Some of our best clients were referred to us by our existing clients. So please feel free and comfortable letting us know the names of anyone who you feel comfortable. Man, I just totally flubbed that. I'm sorry. I didn't like some of the earlier stuff too. It's not. Okay. Some of our best clients, I'm going to make it through it. Some of our best clients were referred by our existing clients. So please feel comfortable letting us know the names of anyone you feel comfortable could benefit from our services or information. We would be happy to add them to our mailing list. Again, one of our primary goals is to keep our clients informed, and we appreciate you watching our update. Please call us if you have any questions. We are thankful for the opportunity to assist you with your financial needs. Remember, at Hutton Wealth Management, our clients come first, and your health and well-being is our highest priority. Okay, I'm sorry, Melissa, I totally screwed that up.